Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, today I'd like to talk about the Melbourne property market. Since the daily index that Coality, or previously called Logic, it started back in 2010, so we've got more than 15 years of data now. And the Melbourne house price has risen by around about 4% over that last 15-year period, which is only about 1.3% above inflation. So, that's pretty disappointing performance, of course. But whilst that's pretty mediocre, it begs the question, what properties have outperformed over that period of time? Because, of course, this is the median, it's the middle point. So it's not correct to say 50% of properties have done better than that, but you would say there's a large cohort that have done better. And so I thought it was an interesting period of time because it's been quite a long flat cycle in Melbourne. Normally flat cycles last about 7 years. Well, we're more than double that. So it's been an interesting flat cycle, and I thought, let's have a look at what properties have outperformed over that period of time, and can we learn anything? Is there anything to learn? Not only, because we plan to invest in a market that's going to be flat for the next 15 years, hopefully, what I talk about in this podcast, hopefully we can avoid doing that. But if we're a long-term investor, we're going to have to experience flat markets. And I guess it's interesting to see, if there's any attributes that property has where it outperforms in a market. I mean, they're the sorts of attributes we want to be chasing. So back in 2020, I recorded an episode about median data and particularly suburb level median data. And the challenge with suburb level medium data is that it's not necessarily reliable. You really have to, firstly, it's the properties, the midpoint of all the properties that sold in that particular quarter. And so you want to make sure they're representative of the properties that you're mostly interested in. Whereas sometimes they can be skewed by the type of purchaser that's more active in a particular market, or it could be there's been a lot of investment in a particular location over the previous years. So a lot of it's as a result of capital expenditure rather than appreciation of underlying land value, or perhaps there's just not enough sales to be statistically reliable. So if you've got quite a small suburb, for instance, you might only have 50, 80 sales in a quarter. You need to really think about how reliable that is. Whereas I think capital city median house data is more reliable from a statistical point of view, but also the problem there is that it's not really comparing like for like properties. So it's not looking at, what is this property worth 10 years ago versus today. It's really just looking at what's the midpoint of all the sales in that particular quarter versus the midpoint of all the sales in a quarter, 10 years later, for instance. And it's useful in so much that it's gives us, sort of a direction of a market and what a market generally has been like over a period of time, and kind of reflects the sentiment thereof. So it's useful from that perspective, but its use, I think, is relatively limited. I like Coality's daily home price index because it uses a hedonic model, which means it's trying to compare apples with apples. It looks at things like location, land size, and dwelling characteristics such as bathrooms, bedrooms, and so on. And it's trying to compare apples with apples. So that's why I like the Coality index, probably more so than the other data providers. And so its index began on the 31st of December 2009, so really start of 2010 calendar year, which means that we've got, nearly 16 plus years worth of data under our belts now. And when you look at the growth rates over that period of time, none of them are particularly fantastic, but I think we've got to look at relative growth, right? So as I said, Melbourne's about 4% over that time. Inflation was about 2.7%. So you can see that's, 1.3% plus inflation over inflation. So that's 4%, whereas Sydney was 5.8%. So another 1.8% over and above Melbourne. Adelaide's done really well, 5.3%, only just a little bit under Sydney. And that's got to, I think, for people thinking about getting into the Adelaide market, just be careful because, the Adelaide probably shouldn't be second on the list. Third is Brisbane, 5.2. And then Perth, I imagine Perth's been doing some catching up over the last few years, but certainly Melbourne's pretty much the outlier in that group of 5 capital cities. So if you compare Melbourne and Sydney, which are really the two major markets, if you like, the growth gap of 1.84% on $1 million property, that's a growth gap of around $600,000. So $1 million property purchased at the beginning of 2010 is worth $2.5 million in Sydney, and it's worth 1.9 in Melbourne, given those different sort of growth rates. And that's even despite the fact that it rains pretty much every day of the year in Sydney. So, the weather, dare I even say it, the weather's much, much better in Melbourne. Now, as I said at the beginning of today's podcast, my thesis is that, not all properties have underperformed. Of course, in any market, and because we're looking at a median level data, as I said, statistically, it's not 50-50 because we're not comparing the same properties, but you would think that there's a reasonable proportion that have done better than the median value. And that's true for every market, by the way. So it's not something that's happening in Melbourne, but even in Sydney, there's going to be properties that have done better than 5.8%, compounding over the last 16 years. And so what I thought would be interesting exercise to pick out a few properties and see if there's any common attributes or if there's any things that don't matter, that we can take away in terms of learnings from an asset selection perspective, and perhaps we can apply those learnings in other markets or even in markets in Melbourne if we're of a mind to invest in that location, to hopefully choose an asset that's going to outperform current market conditions. So outperform in a very buoyant market, but also outperform in an otherwise relatively flat market. So, okay, if I said, let's go and pick some properties in Victoria that have done well, it's going to be pretty easy to do in terms of picking the locations or types of properties that have done well, given just what's happened generally with sentiment, with COVID, with borrowing capacity, with interest rates over the last, say, 10 years. So, of course, regional and coastal areas, they really went through a strong boom over 2020 through to sort of 22, 23. So, that was certainly buoyed by that period of time. And then because of, COVID and tightening borrowing capacities, higher interest rates, and I've mentioned this before at the beginning of the year, in fact, that cheaper properties, so properties in the bottom and second quartile in terms of pricing, have tended to be growing faster than those in the top quartile, for instance. And that's just been the result of a compression in borrowing capacity over the last 10 years because of tightening in credit policies and then also a substantial increase in interest rates. So I could just go out and find properties that kind of fit that profile and said, there you go, these ones have outperformed. But I didn't want to do that because I know that's the general trend. What I wanted to do is actually pick properties that haven't been popular, the types of properties that haven't been popular over the last period of time, because that's where I think we're going to get our best learnings. In fact, that exercise would just confirm what we already know. Those sectors of the market have done pretty well. And I don't think, I think that's a result of macroeconomic settings, not just what's happening really on the ground in Melbourne. So I focused my attention on investment grade locations because they have relatively underperformed. They've underperformed compared to more affordable locations, in maybe sort of second or third level suburbs. And they've underperformed in terms of, certainly a lot of sort of regional locations and also coastal, again, because of affordability, but also because of the COVID effect as well. And so the tide's been pretty flat in those locations. And so I think if I try and identify assets that have done well in a location that hasn't done well or a type of property that hasn't done well, again, I think that's where our learnings will come from. Okay, so I picked 10 sales. I identified 10 sales of, look, I haven't studied the individual properties, but just as a general, they appear to be investment grade assets. And I wanted to have a reasonable holding period as well. So, and the median holding periods of the 10 sales that I've got is 10 years. There were a number of sales I came across that were relatively short period of time. And so, that they might have been bought and sold within only 3 years. And the gain had been substantial. When you calculate it onto an annualized capital gain, it's huge, right? But the thing that drove those transactions might have been randomly perfect market timing. Like if you bought at the end of 19, for example, and then sold it in 2023, you would have got that COVID uplift in many locations and the transaction would look really good. But that's probably because perfect timing rather than anything to do with the actual fundamentals of the property. It's also worth noting of those 10 transactions that I looked at, the holding periods are different, the locations are different purchase and sale dates. So I'm looking at different times of getting in and out of the market, and which means really that we're looking at different market conditions. We've got there's going to be some buoyant phases through there, some more challenging periods, some softer markets. And so I think it's a good representative sample of what I'm sort of looking at. And so if we look at you'll be interested, you'll probably be interested, maybe you won't be. You'll probably be interested in actually what are the properties, what does the data look like? So of course there's a link in the show notes, takes you directly to the blog, and that table is reproduced on the blog, which will give you the addresses, purchase date, sales date, the period that the property was held for in terms of the ownership period, the annual growth of that property. So I've calculated the implied compounding annual growth rate, and then I've compared it to the median house compounding annual growth rate as well, just to give you a bit of a picture of, how's it performed relative to the market. And the difference then is the alpha, is the outperformance. And so if we look at the average across all those 10 property purchases, the median, I shouldn't say average, median, the midpoint. The median holding period is 9.6 years, as I said, around 10 years. It's a good holding period. The median growth is 6.3%. The median growth across those periods of time is 4%. And so the outperformance is 2%. But really you're looking at 4 versus 6.3. So you're really looking at kind of 50% higher growth rate, compared to the median. So I guess what this is saying is these 10 sales certainly outperformed. These 10 sales, as I said, are probably the most unloved sector of the market. And so I think that they're, a good sort of data to go off. But I guess before I do that, I want to point out that it's not statistically reliable. I'm looking at 10 sales here, right? And yes, I could have cherry picked them. I didn't, but I could have cherry picked them. I mean, I could probably find sales, in those locations that underperformed as well. So I don't think, we're not looking at a complete universe of transactions here. I just want to point that out. I acknowledge this, analysis. You could poke holes at it, demonstrate that while there's some weaknesses, and I just want to be really upfront with that I'm not holding this out as a, statistically reliable sort of approach to look at it. But also there's a lot that happens in sales, which I'll talk about in a second, that you don't really know about and you can't find out about. So I'm not sure that even if I looked at, say, 100 transactions, that we'd necessarily be able to draw, conclusions with a higher level of confidence. And I'll talk about, what data don't we have that's really important in a second. But I guess what you could do is, I'm going to share the conclusions or the similarities across these 10 sales. And I guess what you can do is, test it for yourself in terms of your own logic. Does it make sense? Does it hold true? And you can maybe apply these rules in the location, if you're looking at investing in property, in the location that you're interested in, and see if you can observe these principles as well. I mean, property is kind of part science. There's a lot of nuance with it. It's not like we can take a 20-point checklist and run it through the checklist, and if it passes, we go and buy the asset. I don't think an approach like that works very well with property. So there is a bit of nuance here, and I guess we just have to acknowledge that we don't, this isn't a data-based exercise. Now, one of the things that we can't go back and study necessarily, which is a very, very important driver for both the vendor and the purchaser, is how well the sales campaign was executed. So that also relates to the method of sale. Was it a off-the-market transaction, a private sale? Did it go to an auction? If it was an auction, were there 10 bidders? Was there only 2 bidders? Was there no bidders and it passed in? It can materially change the result, both in terms of the starting point, in terms of, the first transaction we're looking at, and then also the end point, which is the final part of the transaction we're looking at. And we're just measuring the growth between those two transactions. In a very buoyant market, properties, good quality properties almost sell themselves. An agent will have an impact, particularly a bad agent could have a negative impact on a campaign. But in a tough market, that's when the agent's skill really matters the most. Setting realistic vendor expectations, pricing out correctly, particularly at the beginning of the campaign as we get towards the end of it. maximizing buyer competition through, inspection traffic and negotiating, and if it's an auction, getting people there to bid. All these sorts of things are really important. So if we're looking at two transactions and one is ran, really, really well, very professionally, they've done as much as they could in a great market, and the other transaction occurred in a very soft market and was poorly managed by the agent, we're going to get two different results. And that could be materially different. Like that could really move the dial in terms of the numbers. And these factors are really hard to quantify, but they can't be ignored. They exist. And that's why I'm saying if we ended up looking at 100 or 200 bits of data, again, it's not really, unless you've got that missing piece of the puzzle, it's not really telling us kind of the full picture, if you like. The other challenge with this exercise is that, as I said, there's a lot of nuance with property. The science is, go and buy a property that's more than 50% land value, and at least you've got that component, that heavy land component, driving compounding capital growth. That's the science behind it. The art is that there's nuance and certain characteristics, relatively minor characteristics, can be important in particular sort of streets, pockets, or buyer segments and so forth. And so, a weatherboard property in a particular location just isn't acceptable, and where they have more sort of brick or brick veneer type dwellings. So that sort of nuance we need to pick up as well. And that's why it is difficult. Even floor plan can have a big impact on buyer demand. So because it's a mix of art and science, again, it's difficult to go back and look over the numbers and look at the attributes and look at the location and look at things like were there any renovations that occurred during the ownership period. All those sorts of things, we can find that data easily, but it might not tell us the kind of full picture. It feels like all I'm doing here is just explaining away the observations that I'm about to make and share with you. But I just really want to be upfront because this podcast is all about an evidence-based approach. And I like to look for, as I've said many, many times, an overwhelming body of evidence that is behind a particular approach, a rules-based approach. I guess what I'm doing here is I'm departing a little bit from this approach. But the key thing I wanted to sort of point out is, yes, we have flat markets, but doesn't mean you need to invest in a way that you're going to experience the same experience as the median data. So it is possible to outperform. And that's true again in a really buoyant market. If you invested in Brisbane in 2018, you've done well. But if you invested really well in Brisbane in 2018, you've done really, really well. And so that's kind of the point, as well as then trying to pull apart some attributes. So I still think this exercise has some value, of course. If nothing, it's interesting. But I just want to really frame that it does depart from the usual body of evidence that I'm looking for to help make investment decisions. As I said, I keep repeating myself, but as I said, the Melbourne market is a very unusual sort of market to be flat for such a long period of time. So I thought, let's take the opportunity and see if we can learn something. Okay, I've got 3 common attributes that appeared to be very common across these 10 sales. And I would say all sales had these 3 attributes, if you like. So they all had what I would say is structural scarcity. Structural scarcity really means because of the location and the characteristics of that location, supply is finite, but demand is substantial. And so the supply and demand sort of tension, if you like, is certainly pulling it or pushing it, is the push behind sort of price appreciation. So all of them kind of had a walkable lifestyle. So there's a lot of amenities within close walking distance to these properties. So all in really good locations. They were mostly positioned in good suburbs, in quiet streets, in attractive pockets, and in parts of the suburbs that commanded a premium. And maybe there was only one exception to that. And that was a property in Balwyn North, and it was on a busy main road. It's not a busy main road, but it's a relatively busy road. And actually, no surprise that it delivered the lowest alpha. So it outperformed by the lowest amount, probably reflecting that element or that shortcoming really. The other thing in these locations were that subdivision typically was not economical to do. So that means structurally supply was fixed in terms of the number of dwellings, except for, in some locations, and this tends to happen in more busy main roads, where developer might buy a couple of blocks, bulldoze and build a block of apartments. That tends to not happen in quiet streets because the land value component's just too high, and so it's uneconomical. And so many of these locations, these 10 sales are located in, just aren't economical from a development perspective, from a small scale development perspective. What that means is that we're not getting, a large family home bulldozed and 3 townhouses built. That's not happening in these locations. So structurally, we've got very fixed supply of the number of dwellings in that location. And the other thing is a lot of these properties are in good school zones, either good public school zones or very close to desirable private schools. And so again, this is just another multifaceted element that's kind of underpinning the demand. But I think what it shows is that, if you pick a blue chip suburb, you can't just buy any property in that suburb. What we're trying to do is buy the highest quality asset we possibly can. And that really means making as fewer compromises as possible. So we're really better off to buy in the most desirable pocket or the most desirable street, because again, it adds that additional element of scarcity. If you've got a suburb, everyone knows Toorak, so I'll just use it as an example. If you've got Toorak, that already sort of comes with a bit of cachet and scarcity and desirability. But if we're buying in one of the top 10 streets in Toorak, we've got that additional level of scarcity. So I've often talked about, a property asset, a really good quality property asset has to have something about it that's really unique and really desirable. In Sydney, that could be water views, for example. In Melbourne, it could be, in a really great street, in a great school zone with walkable amenity. The next observable thing was that in 3 cases, in 3 of these sales, they benefited from renovations. And so where the renovation cost was material, I've adjusted the compounding capital growth rate. So I've adjusted for the fact that we've contributed more capital. So what I'm trying to do then is really reflect the increased value of the underlying land. But of course, it seems like in these situations, the value add to the property as a result of the renovations were more than the cost of the renovation. And the reason for that is it just increased the marketability of those assets, particularly over the last 5 or 6 years. There's a period of time when, construction costs were rising and people just didn't want to take on a renovation project because they, didn't know how much it was going to cost them at the end of the day. But I've previously spoken about a value add property strategy where you spend most of your money, most of your budget on buying, good parcel of land. And then after you own the property, not necessarily immediately after, but at least some point down the track, you make improvements to that property that not only enhance its value and hopefully enhance its value beyond the cost, but also materially enhance its marketability so that it's attractive to, a much wider buyer pool. And so if you want to go back and have a look at that episode, that's episode 387 that I recorded in December last year. Notwithstanding that, once you improve a property, you increase its cash flow profile. If you borrow to fund those improvements, typically the cash flow improvement is more than offsets the higher interest cost. And notwithstanding that, you get the tax benefits associated with depreciating those capital improvements. And the final common attribute is they're all in locations where there's above average household incomes. And I've written about this before and spoken about this before in the podcast, that you've got to think about the future buyer. And so how is that future buyer going to afford to pay more and more and more for this property? And in the absence of a sustained expansion in borrowing capacity, which I don't think is going to happen, which happened over the last 20 years, and 30 years or even 40 years going back further, but I think borrowing capacity is going to be pretty stagnant for the next few decades. So therefore, what you're really relying on is the future purchases, financial capacity expanding, which is either an expansion in income or sources of other revenue or income, whether it's business, inheritance, employee shares, these sorts of things. Well, all these properties are in locations that attract a demographic that is going to have those alternative sources of wealth. Now, that might not be that important today because, when you look at the market and certainly the last 5 years, cheaper properties have done better, but they're going to get to a ceiling where we can't afford to buy anymore. It means those buyers then have to spread out, go further out, but it means that the buyers that don't have to compromise will come further in, and the relative value just looks better and better as well. Now, there's a couple of attributes that didn't matter, common attributes that didn't matter, and these are important to point out because quite often people sort of bring this up. The first one is land size. land size was not a key driver. I mean, the quality of the land and the value of the land, of course, are very, very important, but the actual amount of land that you're getting, less important. So the smallest property in Albert Park was on a block of 105 square meters. That's a pretty small block. The largest, that was more of a sort of family home style, was in Baldwin North on 766 square meters. That's relatively large. But most of the properties, Middle Park, Fitzroy North, Hawthorne, Yarraville, and Fairfield, were all on blocks around about 150 to 300 square meters. So this is the thing that sometimes buyers think about. Like, if I go further out, I get more for my money. And surely that, that's more attractive to more purchasers. The reality is that it's quality over quantity. And that's always been true with respect to property. And I guess this data demonstrates that as well. The other observation also were heritage restrictions. So several of these properties are subject to heritage overlays, which means you really can't change the streetscape of the street, which means that if you can develop, as long as you can develop and not see it from the street, typically, just as a general rule, tends to be okay. Now, sometimes people think, well, that actually enhances the value because it maintains the characteristic of that location. That's true. Other people says it might take the view that it destroys value because it means that, there's no alternate use or limits the alternate use of the property. And I guess that's true as well. But I think in this observation, I would say that it hasn't harmed the growth rate. And I think if you're investing in those types of locations, heritage overlays and some sort of heritage restrictions are probably to be expected. And the other thing to think about too is, even if you're buying a location where heritage overlays are common, but the property you're buying doesn't have a heritage overlay, that's not to say that if you own that property for the next 30 years, at some point, those restrictions might be applied to that property. I've had that experience myself personally. So, but I wouldn't worry about it too much unless your plan or your total strategy is, solely relying on developing the property. Of course, then it's a problem. But if it's really a buy and hold strategy, typically, this is a generalization, it's not going to worry us too much. So putting it all together then, previously I've espoused the idea of really thinking about property cycles. And if you're going to invest new money into the property market, particularly if you're borrowing that new money, you probably want to put yourself into a position where you are exposing yourself to better returns over the first decade, maybe higher than average returns over the first decade. And the reason that's important is not because you're going to move the dial in terms of average long-term return, but you can then just leverage that capital growth and continue to build your financial situation, as well as it makes you feel more confident about making future decisions as well. So that still matters. I still think it matters that we need to think about where is a particular location in the growth cycle, and will there be some mean reversion. But I guess this analysis also demonstrates that even if you completely mess that up, it's not impossible to do well, to still do well, or at least better than the average. And if the outperformance is 2%, it was on the 10 sales I looked at, that closes the gap on the difference in median performance between Melbourne and Sydney, Sydney being at the top and Melbourne being at the bottom. And the gap was only 1.8%. And my alpha here is 2%. So it shows that asset selection, certainly market, you've got to try and get that right, but asset selection is fundamental too. And I think maybe this is where some people are going to get caught out, where people have been of a mind, well, Brisbane's going gangbusters, it's got the Olympics, so we'll just buy any property anywhere in Brisbane. And there's certainly some buyers agents that are out there that aren't necessarily overly selective about the types of property they're buying. That works in the short term, but if people have done that, they really need to consider, does this property have the attributes to drive growth over the next 20 or 30 years? Because that's how wealth is built. That's how compounding capital growth works. And it's important to get that right, more so than getting the market right. So again, if you invest in Melbourne 15 years ago, instead of earning 4%, you've done 6% because you've got the asset selection right. If we extrapolate what we've learned here today, well, that's not a terrible outcome. It's not a great outcome, but it's not a terrible outcome. But most importantly, if you're going to hold this asset for 30 years, it's got the attributes and certainly will benefit from mean reversion eventually, and it's got the attributes to drive strong capital growth over the longer run. And I think what this does is shows us or demonstrates that asset selection is by and far the most important thing. Buying the right asset is most important. Then the next important aspect is getting into the market at the right time in terms of the cycle, and then holding that asset for a very long period of time. And if you can do all three of those things, there'll be a lot of things that change over the journey. Interest rates, borrowing capacity, capital gains tax, negative gearing perhaps. All these things will change. Sometimes the settings will be, accommodate you as an investor. Sometimes they won't. But over the long run, at the end of the day, the compounding capital growth is what's going to do all the heavy lifting. And no matter what the sort of tax settings are, you're probably going to walk away with, 2/3 to 3/4 of that gain on after-tax dollars. And that's how property is really going to help you build wealth. Okay, I'm going to leave it there for today. And next week, I've got a episode that I have called, wait for it, How to Avoid Working Too Long or Underspending in Retirement. I think it's going to be a relatively popular episode. Anyway, I get to share my thoughts around that topic. And until then, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.